Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host, Sandeep Rao. In our last episode, I spoke about 3 streams of data that can be used to make trading decisions: technical, fundamental, and alternative. Today, I want to take that conversation a step forward. If you've been following The Long and the Short show, you know I have been laying out the broad outlines of the trading landscape. Now that the big picture is almost complete, it's time to zoom in a bit. In this episode, I will share something very interesting with you all. Now think about it for a moment. Let's say you are exploring a trade idea and someone asks you the question, what is this trade trying to do? Or they ask you, what phenomena is it trying to capture? Now you may say, why should I know that? Well, the reason you should know that is because it helps you structure your trade better. You see, I am reminded of this classic Alice in Wonderland situation where Alice reaches a fork on the road and sees the Cheshire cat on a tree. Alice asks the cat, which road do I take? The cat says, where do you want to go? I don't know, Alice responds. Then the cat says it doesn't matter. That's a bit similar to what happens in trading when you don't know what is the phenomena you're trying to capture. And once you know that, all other things fall in place. Today's episode will help you answer that very question. We will talk about 3 foundational archetypes of trading strategies, a simple lens that helps you make sense of almost any strategy in any market. The best place to start is with the most intuitive of the 3 archetypes, and also my personal favorite. That's trend following. So what exactly is trend following? Imagine there's a stock trading at 100. Over the past few weeks, it's been steadily climbing, and you think it could go to 120, maybe 130 or even 150. The truth is you don't know how far it'll go, but you don't need to. What you want to do is to ride the uptrend as long as it lasts. Now here's how you could structure a trade. You buy the stock at 100 and place a stop loss at 90. That's a 10% cushion in case something goes wrong. As the stock moves in your favor, you trail the stop loss upward to lock in the gains. So when the price hits 120, you move the stop loss to 108. If it reaches 130, you move the stop loss further to 117. This way, you keep capturing more of the trend while protecting yourselves in case the trend suddenly reverses. Of course, sometimes if your luck is like that of mine, the opposite happens. You buy at 100 and almost immediately it falls to 90 and hits your stop loss. That's a part of the game. Losses are quite frequent in trend following, but the big wins make up for all those small losses and still leaves you with a profit. At its core, trend following is about 3 things. A. Trend identification, identifying the direction or the trend based on price. B. Trade initiation, taking a position in line with that trend, long or short. Do remember, some systems trade both the sides, others stick just to long or short side. C. Trailing stop loss, using a trailing stop loss to limit downside and let your profits run. That's an essential 3rd step in trend following. In simple terms, trend following is about trying to catch an existing price move and ride it for as long as it lasts. In reality, trend following is a low win rate approach as a lot of trends tend to fail and you'll have to take many small losses. But the magic lies in the few big wins that more than make up for everything else. But what I personally love about trend following is its simplicity, elegance, and a long history that supports this idea. You see, traders have been trying to catch trends for centuries, even before modern finance came into existence. You can trace it back to the Dutch East India Company in 1600s, to Japanese rice traders in the 1700s who even came up with the concept of candlesticks on charts, and later to Charles Dow in the late 1800s who really formalized the idea of trend persistence over time. I actually touched upon Dow's work in the How to Read the Market Right episode. Now fast forward to 1950s through 1970s, trend following started becoming more and more systematic. In the US, commodity trading advisors, or CTAs as they are called, began creating trading systems based on the concepts of moving average crossovers and breakouts. One of the pioneers of this era was Richard Donchain, often called the father of trend following. He came up with simple but robust rules-based ideas like moving average crossovers and breakouts. In 1949, he launched the first publicly managed futures fund called Futures Incorporate. This was long before CTAs became a thing. His idea of Donchain channel is still widely used as an indicator today. And then, of course, there's this famous story of turtle traders. Richard Dennis, who was a hugely successful futures trader, believed trend following was so simple and straightforward that even people with zero experience could learn it. In the year 1983, he decided to put his belief to the ultimate test. He took in a group of complete novices, later nicknamed as the Turtles, and trained them on a simple, rules-based trend following system. The results were incredible. Many of those turtles went on to become hugely successful traders in their own right. Jerry Parker, for example, went on to found the Chesapeake Capital, which is still one of the longest running trend following firms in the world. Now, in that sense, I'm a bit like Dennis. I also believe trend following can be taught and learned. The hard part isn't the rules. Those are simple. It's the psychology that makes it so tough to stick with. You got to be able to take 1,000 cuts, and that's easier said than done. By the 1990s and 2000s, trend following had grown into a big business. Fund managers like Bill Dunn of Dunn Capital and David Harding of Winton scaled these strategies into billion-dollar funds. With more data and faster computing and access to global markets, trend following became more quantitative, but the core principles never changed. Cut your losses short and let your profits run. I think it was David Ricardo who said it first. Now there are plenty of critics and naysayers who have argued that today the markets are way too efficient for trend following to work, and yet history keeps proving otherwise. Trend following funds have delivered consistently in good times and bad. In fact, they tend to deliver strong returns, especially during major crises. Think about the 2008 financial meltdown or the COVID crash of 2020. There's even a term for it called crisis alpha, meaning trend following strategies tend to work best when everything else is breaking down. And that's why even today it continues to be a cornerstone of systematic trading. Hedge funds use it, CTAs use it, and plenty of individual traders like me use it too. Honestly, the fact that I've been talking about trend following so much should probably tell you by now how much I personally admire trend following as a trading archetype. Alright, so the next big archetype is what we call mean reversion, sometimes called reversion to mean. Fair warning, the idea is very simple, but once you dive into the quantitative side of it, it can feel a little less intuitive. Still, it's not rocket science. The way to think about it is with an example of a rubber band. Imagine its resting state is the mean. Stretch it away from the resting state and eventually it snaps back. That snapping back is essentially the reversion to mean. Prices of securities often behave the same way. They go away from their mean only to come back. Back in my early trading days, I had a friend who would hunt for stocks at the 52-week low, expecting them to bounce back. At that time, I didn't realize it, but he was actually practicing mean reversion. He never really made money doing it though. Just spotting a low isn't enough. You need a way more robust system to trade mean reversions. Now, I must say that relative to trend following systems, mean reversion systems have better win rates and hence could be psychologically more comfortable to trade. So let's try and understand what this mean reversion is all about and how does it work. Now, you can't have reversion to mean without a mean in the first place. Just like if you say, I want to go back home, there has to be a home in the first place for you to go back to. In trading, the mean is usually some kind of a rolling average. It could be over the whole dataset or just a chosen window of time. I won't get into the mechanics here. Instead, I'll link some varsity videos in the show notes. For example, you may have a strategy where if a stock or an index falls for 5 consecutive days, you would go long. Or you could have another strategy where an index or a stock drops 10% and then you go long. All those strategies are mean reversion strategies at heart. Mean reversion has an interesting history to it. The roots of it go way back to 1800s when Francis Galton, a statistician, anthropologist, and a cousin of Charles Darwin, was studying heredity. He wanted to know if children inherited traits like height proportionally from their parents. What he found out was fascinating. He figured that heights were not proportionally inherited. Instead, heights tended to revert to the population mean over a long period of time. That's where the term reversion to mean came from. If you want to go into this rabbit hole, there's a great New Yorker article called Measure for Measure that covers Galton's contributions to statistics, heredity, and yes, even some controversial stuff like eugenics. I'll drop a link in the show notes. Years later, in the year 1930s and 40s, Alfred Cowles studied stock returns and found evidence for mean reverting behavior in certain periods. By 1980s, John Bollinger developed Bollinger Bands, which could be used to visualize how far prices deviate from the moving averages. That was a direct application of mean reversion and quite popular even today among technical analysts. But the big leap came on the Wall Street in 1980s. With digital price records and computers becoming widespread, quant traders at Morgan Stanley pioneered pairs trading, taking two historically correlated stocks and betting they would converge back if they had diverged. That became one of the first big statistical arbitrage strategies, and versions of it are still traded today. From there, hedge funds like Renaissance Technologies and other quant shops wove mean reversion models into their market-neutral portfolios. And with high-frequency trading post-2000s, mean reversion has even been applied at microsecond scales, picking off tiny, fleeting price dislocations. Today, mean reversion sits right alongside trend following as one of the two dominant archetypes of systematic trading. Mean reversion started with a simple observation that extremes don't last forever. It grew into pairs trading in the 80s and remains a core building block of modern-day systematic trading. And here's the interesting part. Trend following and mean reversion aren't actually at odds. If you look at any price series, you'll often find both tendencies, just that the tendencies happen on different time scales. For example, a stock might look like it's trending on the hourly chart, but mean reverting when you zoom out and look at it on the daily charts. With trend following and mean reversion done, we now move to the third and the final archetype, and that is arbitrage. In some ways, arbitrage is a cousin of mean reversion. You'll see why in a bit. Of all the trading strategies, this is one that gets math nerds most excited because, at least in theory, it promises the holy grail. And that's profits without risk. And honestly, who wouldn't want it? Here's a simple way to think about it. Imagine you're shopping for an iPhone. On Amazon, it's listed at 1 lakh. On Flipkart, the same phone is selling for 1,10,000. If you could buy it on Amazon and sell it on Flipkart, you'd pocket the difference. That's arbitrage. In markets too, something similar happens. Suppose Reliance is trading at 2,000 on NSE but 2,010 on BSE. You could buy on NSE and sell it on BSE, instant profit. Of course, in reality, these opportunities don't last. And even if they do, post-transaction cost, nothing much may remain if you do it on a small scale. There are high-frequency trading firms that do only this. They have algorithms that jump in so fast that by the time you notice an arb opportunity, the gap's already closed. That's why they say true risk-free arbitrage is rare and super hard to capture. The essence of arbitrage is this. Just like the mean is central to mean reversion, the idea of fair price is central to arbitrage. If you can calculate what something should be worth, in other words a fair price, then anytime the actual price deviates from the fair price, you know whether to buy or sell, betting that it'll converge back. That convergence, in a way, is similar to mean reversion. And like trend following and mean reversion, the concept of arbitrage has been around for centuries. If you go back in time, in 1600s, Dutch merchants bought East India Company shares in one city and sold them higher in another. In early 1800s, during the Napoleonic Wars, traders exploited bond price discrepancies between London and Paris. There were a few other interesting developments which were happening. In 1900, Louis Becquelier introduced stochastic price modeling in his thesis Theorie de la Speculation, laying the foundation for modern fair pricing. By 1970s, the principle of no arbitrage was formalized in the Black-Scholes option pricing model, which assumes that if prices deviate from their fair value, rational traders will act to close the gap. But here's where the theory collides with practice. Talking about mean reversion, arbitrage, and Black-Scholes reminds me of the famous LTCM debacle. LTCM stands for Long-Term Capital Management. That was the name of a hedge fund in the 1990s run by Wall Street legends and even Nobel laureates, including the folks who created the Black-Scholes model. Now, for a few years, LTCM delivered spectacular uncorrelated returns by betting on arbitrage trades. Then one fine day, it all went bust. In 1998, the trades that were guaranteed to converge didn't. Liquidity dried up, spreads blew out, and LTCM was so over-leveraged that even though they were right in theory, nothing could save them. The fund eventually collapsed, forcing the Fed to bail them out. If you want the full story, Roger Lowenstein's book, When Genius Failed, is a must-read. It shows exactly how assuming mean reversion or no arbitrage as some sort of a natural law can be fatal. The lesson here is sometimes market mean revert, sometimes they trend. It's hard to predict. But if you are over-levered, that's what can kill you, even if your math is right. So far, we have talked about three big archetypes in trading: trend following, mean reversion, and arbitrage. Each of them captures a different way of looking at the markets. Trend following says the market moves in waves, catch the wave and ride it. Mean reversion says extremes don't last, prices eventually snap back to some sort of a mean. And arbitrage says fair value exists, if prices diverge from it, they will converge back. At its core, all three archetypes are about the behavior of prices and the information prices contain in themselves. Given that there is so much that prices can tell you, maybe that's the reason why there is this saying called Bhav Bhagwan Che among traders in Gujarat, which means price is God. And that's why I hate it when people call these archetypes mere theories. To me, they are the backbone of all trading strategies. It doesn't matter whether the strategies are used by billion-dollar hedge funds or solo traders. Almost every strategy you'll come across is built on one of these three archetypes: trend following, mean reversion, or arbitrage. Over years, for me, the real insight is that these archetypes don't compete with each other. They actually complement each other. And once you see that, markets start to make a lot more sense to you. And here's one more thing. In the future episodes, I'll show you how these archetypes actually work in today's markets, and sometimes in ways that you wouldn't expect. So that brings me to the end of part 1 of this episode. With that, let's move to part 2, something more practical, and that's our weekly market metrics. Let's take a quick look at how the markets played out this week. As I had expected last week, the up move in the indexes continued this week. I had expected a close around 25,500. However, though we got a weekly high of 25,450, the week closed at about 25,327. On Monday, Nifty gapped up with just about 5 points, but then followed through on the upside for the whole week. Between last Friday and this Friday, the index has moved up 213 points, that is around 0.85%. That's on top of 1.51% move that happened last week. Nifty had positive gaps for 3 out of 5 days this week. Talking about support and resistances, 25,450 to 25,500 is a resistance zone and 25,250 is a key support level for Nifty. Let's see where the next week expires. If we zoom out a bit, all indexes, including Nifty, have had 3 back-to-back positive weekly closes. We've been talking about Nifty being stuck in a tight range of 5.4% on the weekly chart. We still continue to be in that range, and this would be the 14th week in that sense. Coming to Bank Nifty, the index is up 1.19% this week, again a third positive weekly close in a row. As far as support and resistance for Bank Nifty is concerned, 56,000 is a resistance and 55,000 is a support, both big round numbers. And this is on a daily chart. Talking about the rate of change this week, all indexes are in green. On a month-to-date basis, except for Bank Nifty, all are in green, and on a year-to-date basis, everything is in green. Nifty mid-select was the highest gainer this week with 1.20%, followed by Bank Nifty at 1.19% and Nifty at 0.85%. For the calendar year 2025, Nifty Bank is showing the highest gains at around 9.04%, while Mid-Cap Select is merely up around 2.58%. It's the weakest of the lot. Nifty is up 7.11% and Sensex 5.74%. Talking about sector-wise market this week, we have PSU banks at the top, followed by realty and energy. PSU banks and PSE continued from last week, as you can see them in blue. Realty, energy and infra are the new entrants this week. Talking about commodities in general, while gold made a new all-time high, at the moment it looks like it's consolidating along with silver. Copper has a bit of a negative bias, natural gas is in a downtrend and crude is a bit flattish. Talking about overnight versus intraday structure on the indexes, this week the gains came from both overnight and a bit from intraday. As far as Nifty was concerned, overnight it did around 0.55% and on intraday basis it did 0.28%. If you are an options trader, the Nifty weekly expiry on Tuesday had a range of 199 points, highest daily range this week. The expiry was good for directional players as the index went up throughout the day. It closed 170 points, which is around 0.68% up from Monday's close. It was not an easy expiry by any measure for non-directional traders. Sensex, on the other hand, had its weekly expiry on Thursday and had a range of 436 points, which is above its weekly range of around 420 points. It followed the FOMC announcement on Wednesday night and opened with a big gap of 415 points, that's close to 0.5%. The index gave up all the gains and filled the gap but closed 95 points down from the open, but 320 points up from the previous day's close. Good for sellers in the morning, not so much for the last 1 hour because of the up move. Talking about VIX, things are not getting any better with it. Last week we closed at 10.12 and this week we closed at 9.97. So the low VIX scene continues this week again. Let's see what happens next week as far as VIX is concerned. Talking about directional bias, all the indexes, Nifty, Bank Nifty, Midcap and Sensex are above the 21 and 50 period EMA. All directional indicators indicate a positive bias. Moving to our outlook for the coming week, directionally again, it looks like the coming week Nifty may continue its up move. Now, as far as the average weekly range is concerned, it's around 400. If the close has to happen on the upside, it could be around 25,700. Though this Friday's market move may have looked like a pullback, the general bias continues to look positive. The short time frame trend following strategies that I track on Nifty and Bank Nifty continue to be positive since last week. Nifty especially has been long for close to 11 days now. Beyond this, there are no scheduled events in the coming week and no market holidays either. So that's pretty much for the long and the short this week. Thank you for watching, and yes, please do like, comment and subscribe to this channel.